Hello. Are you sick and tired about hearing about how to get into the property market? It's not that hard. It's just that you need to do this, that, or the other. There might be different first home buyer grants all under the same umbrella, but you're still wondering, golly gosh, what does that mean? Well, I'm here to explain one of the government options that is to aid first home buyers, and that is the First Home Super Saver Scheme. I personally think it's one of the largest benefits that you could give a first home buyer, and I have personally used it to buy a property. So my name is Tally, I'm a finance professional, but really I'm just a very passionate girl who doesn't have a large enough audience in my personal life to share this information. So I would love to be able to do that for you. So if you haven't already heard of the First Home Super Saver Scheme, it was introduced in 2017 and then the limits increased post 2022. So it's been around for a while, but I would say that it's not something that necessarily people who are looking to buy a home remember to do, or maybe it's just that super is such a long-term future scheme that you just don't think about how that could help you to buy your own first home. So essentially it's a government initiative and it allows you to put excess money into your superannuation at the super tax rate rather than getting taxed at your marginal rate. So it's a voluntary contribution. You can either do this by salary sacrificing throughout the financial year, that is from July to June, into your superannuation, or you could do it as a lump sum payment after tax, and then you'd still get that deduction into your superannuation. So when you get taxed through your super, it's just a flat 15%. Whereas if you get taxed, if you're using money to purchase your own home, after tax rate would be marginal, which is typically a lot higher than 15%. And it just depends on where you are on your income scale. But this scheme does help people even if they're earning as little as $50,000. So currently you can contribute $15,000 per financial year. That's from July to June in Australia. And you can access up to $50,000 of eligible contributions in total. So if you were to put the maximum of $15,000 per financial year, you could effectively have $50,000 of the total amount that you are currently eligible to take out of your superannuation within 4 years' time. Now, if you are fortunate enough to be able to buy with a partner who also hasn't bought their first home, they are also able to do this salary sacrifice into their superannuation and get that same benefit. And then you both could then obviously withdraw from that and then purchase the property together. So that's a really great way to double up that benefit between the two parties. And there's no issue, say if, for example, you're a person who is buying with maybe a co-contributor is a parent who obviously has their own property, there's no issue with you still being able to withdraw your particular amount for the deposit because it is still your first home, even though it wouldn't be the co-contributor's first home. So that's all really good information there. But one other thing to note would be contributing more than $50,000 in the financial year would mean that anything above that would never be released, even if it's forming part of, even though you've contributed in total more than $15,000 and it's less than the $50,000 cap. So that's a little bit convoluted, but your cap per financial year is $15,000. Put $16,000 and you effectively will not be able to touch that $1,000 until you reach preservation age, which is currently around 60. However, if you then put $15,000 in one financial year, $15,000 next financial year, and then you'd be able to withdraw both the $15,000 to make $30,000, as that's below the $50,000 total contribution cap. So I guess I don't want to be like a real stickler. It's not overly complicated, but that's just one thing to note to make sure that if you are salary sacrificing throughout the year, you're not accidentally contributing too much if your only intention to build up your super was to then withdraw it for your first home scheme. The other thing to note is to be eligible, you generally need to be 18 years old, makes sense, and never owned a property in Australia and intend to live in the property you purchase. So for many Australians, this is a no-brainer if you have not previously owned a property. And then once you withdraw that money, you need to notify the ATO within 90 days of signing the contract to purchase or construct your home. So if you're sitting there watching my video pre-30th of June and you're thinking, I still want to make contributions for FY26, well, the time is definitely ticking, and I perhaps made this video a little bit too late in this year, but if you stumble upon this in future years, maybe this will still help you and you've seen it throughout the next financial year. So if you're a bit tight for time and we're already in June, for example, you need to contact your super fund immediately that you are with. I would ring them. I would find out what is the date that is their cutoff, because each super fund actually has a cutoff for eligible excess contribution. And say if it was tomorrow and it's today, I would be making a BPay payment because they're instantaneous, just to ensure that you've got that amount through. The next item is you must notify. The next item is just to go through some of these convoluted terms. So what contributions count? So salary sacrifice contributions. So they're when you tell your employer, if you're getting a paycheck of $2,000 per fortnight and you want to salary sacrifice $500 of that, you're telling your employer to never receive $500 of the amount and have that put straight into your superannuation. And that would be a salary sacrifice contribution and part of that amount that you would be able to withdraw. A personal contribution, you could have a personal contributions when you claim a tax deduction. So that would be after tax, the amount you receive in your bank account, and then making the $15,000, or you could do it in two halves, like 7.5K each. So that would also work in your favor. And then the other items that wouldn't count towards this are any existing super balances that weren't in excess over the past years. So these are typically just employer superannuation guarantee contributions. So part of the 12% that is currently the super guarantee amount. So if you're wondering, well, I've had some terrible circumstances and I've come across your video, and if I was able to purchase a property, this would really help me out. Well, do not fear. Actually, there's a form on the ATO website for difficult circumstances. So say if you've had a divorce, a relationship breakdown, an illness that set you back, bankruptcy, any deemed difficult circumstance that's put you in a financial situation where you're effectively homeless if you weren't able to rent or rely on family, I would highly encourage you to apply, do the paperwork, and start salary sacrificing. It's just a great way for you to get back into the market and give yourself that lead that you would need. The other item that I just wanted to cover in this video is just how to access the funds. So you just simply request you go into the ATO and you confirm the maximum amount you want to withdraw from, and then on the FHSSS determination, you sign a contract to purchase. Once you've received those funds, typically within 15 to 20 days, and then you apply for the release. So you don't only just get, say you contributed 15,000 in 1 year and 15,000 in the other year, and that's 30,000. You'd actually get the associated earnings with that release. So that's a really great way to also benefit, because you're not only getting the tax benefit, but you're also getting the investment returns that you get from being invested in a superannuation fund. So that's all that I have. Say if you had, for example, some outstanding ATO debts, that may make it a little more problematic in that the ATO could release it from the outstanding debts. But that wouldn't be part of, for example, a HEX debt or a tradie port loan. So really, this is a great initiative. It's a step in the right direction to help support Australians buy their first home. I believe that it is fairly unused currently, and there's definitely good scope for people to get into this. And especially if you're a couple, you're just only doubling that effect, and it'll probably increase in future years just as the property gets harder and harder. I really encourage you to use it, but again, it's really about what's best for you and your own circumstances. So you're going to have to assess it by using the links and reading up on it. But this is just to raise awareness that if you are sitting there and you haven't heard about it, this is a great chance to really learn about this and then assess for yourself, talk to your own family, peers, people that you trust, to make sure that they don't have any reservations with you doing it either. Thank you so much for watching my video. I've got other videos of the same vein that help you to uncover topics that might not be readily available to the average person, and give me a thumbs up if you thought it was great. Thanks.